Okay, we've got a special voice now joining in, someone who can make sense of all that is happening globally for us here and distill the impact. Adrian Mowat is emerging equity markets strategist. Adrian, great to have you with us here on the program. It's always a pleasure. So let's start by asking you about what your view is. I mean, the CPI number in the U.S., would you agree was a bit of a game changer in the short term? Because if the central bank there was looking for steps and a couple of prints of lower inflation, I mean this was a step backwards, not just for the Fed, but I guess more for the market, which was at every turn expecting that inflation is no longer as big a problem as it was. This number showed it is. Your sense?
Good morning. Well, I'd agree with what Chris Wood at Jefferies is saying, that the CPI print is the most important data point for markets. And it was a disappointment, and we watched markets, the S&P fall 4%, NASDAQ nearly 5% on the day with that number. But I think the important thing is to look forward and think about how CPI is going to be trending as we move into 2023. And I think the trend will be, it is coming down. I mean, you were highlighting the FedEx numbers. If you look at what's happening for shipping rates, shipping rates Shanghai to LA are down more than a third over the last 12 months. FedEx is seeing weak demand for the movement of physical goods, and they're going to be losing pricing power because of that. So I think the trend is still in place of declining inflation as we go into next year, but we're going to experience these bouts of volatility with each data point. What I think is encouraging, though, is that even with Fed Fund futures now forecasting 13 months out, the Fed Fund rate at 4.25, that the S&P hasn't sort of retouched its June lows. And my sense is that we're developing a little bit of a scar tissue to these inflation prints, and that the market probably is going to become more focused on the economic weakness as you go into 2023 rather than inflation. And I think that's going to be very important for the rotation in the market. I was quite intrigued to see how banks in the US seem to outperform this week. And maybe what people are saying there is, look, banks are about the nominal economic activity. They benefit from higher rates. And at the moment, credit costs seem to be quite low. So I think the story here on inflation, yeah, the print was bad, but think ahead. I suspect the inflation prints over the next quarter or so will actually be better.
Adrian, good morning. One market which, like the back of your hand is India, right? What have you made of this significant outperformance that we have seen? It's almost as if, nothing seems to matter to Indian market. And you were talking about the U.S. banks. Look at what Indian banks have done. Your thoughts on what's happening here in India?
Yeah, so the Indian economy looks very resilient on a global stage. Particularly within emerging markets. And when you look at the emerging market cap, very large percentage is China. China continues to struggle with its zero COVID policy. Then Korea and Taiwan are dominated by large tech companies, which are quite cyclical tech companies in terms of they're in the semiconductor space. So those markets are unattractive. So I think within the EM space, India looks the best place to be for international investors. And then domestically, what I hear from my contacts in India is an economy that actually feels very robust, a sense of resilience, a sense of an economy that's really pushed well beyond the pandemic. And so I think the fears around earnings in India are probably low relative to what we see in markets such as the US, Europe, and China.
Oh, absolutely. The other day, someone from London was visiting, and they said that India is the most bulletproof market compared to what they've seen globally, especially after what's happening with the energy crisis in UK and Europe. But having said that, this is a market that has run up quite a bit, right, Adrian? I mean, the Indian market is up 16% in the last 3 months. That's no mean feat. Do you think it's a little late in the day to enter now, or is the risk reward still favorable?
So it's, if we had a discussion in isolation, just looking at the Indian market, unaware of how much NASDAQ and the S&P has fallen this year, the Nifty is still below where it was in late 21. And you might be quizzing me and saying, well, are we ever going to get any performance out of the Indian market? And really what we're highlighting here is India hasn't fallen while other markets have fallen. But if we look at the Indian market, the economy is growing. There is earnings growth. And so, if we hadn't got that data point, which is the US market's fallen a lot, I think our narrative around the Indian market and the questions you'd be asking me would be quite different. So I think it's fine at this level. Can it move ahead meaningfully when other markets are falling? I suspect it can't, but it is notable just how resilient it is, how the market is really barely off its recent highs. But I think that makes sense with the fundamental story in India.
Adrian, I don't know if you read what Mohammad Apabai of Citi, who's the head of Asia Pacific Trading, writes. I mean, he writes regularly with regards to where markets should be with respect to global central bank liquidity. And according to him, their model shows that the market in India is one of the most vulnerable to global central bank liquidity. I mean, whatever model that may be. And they've been writing for a while and they've been wrong. The basic premise is that central bank liquidity is coming off sharply. And so far, markets are not paying attention, but they will eventually. What do you make of it? And it seems completely something very, very different, right, compared to what is actually happening. The market here is 3-4% away from all-time highs. And then you got a view like that. What should one do with that? Completely ignore it or be aware of what's happening?
Well, I struggle a little bit with these central bank liquidity models because we're in a period now of quantitative tightening after a period of quantitative easing. Now, I've been looking at equity markets since '88, and quantitative easing came late in my career, I'd argue, post the global financial crisis. And we had a bit of tapering coming into 2014, but it's only now that we're seeing a meaningful quantitative tightening. So I don't really understand how you can have a model for that because, models are about back testing cycles and you need multiple data points, multiple cycles in order to have a robust model. So I'm not sure why India specifically should be more vulnerable to this. I think there's also a great danger of looking back at 2013 and the tapering scare and extrapolating what went on there versus the current environment. I mean, one thing we all seem to be forgetting is we've just come out of a pandemic. We've just come out of some of the biggest ever demand shocks economies have seen. We've just come out of, very significant fiscal and monetary swings in order to help the economies. The Omicron variant was only identified in South Africa in November last year. And the reason I'm bringing this up is I would argue that, governments and policymakers have been cautious, they've been risk averse, they've been attuned to issues just as the corporate sector has been, as they've had to deal with this incredible volatility in demand. And to me, that makes markets more resilient. It makes economies more resilient. It makes corporate earnings more resilient because we've just come through such a troubled time. So back to India, you would make an argument about India current account deficit deteriorating with the high oil price, but we've proved to be pretty resilient. There's no particular concern about India balance of payments at this point. So I'm not sure I agree with the model. Sorry, the very long answer to a simple question, but I'm not sure I would have confidence in the model, quite frankly.
Okay, just one last quick question, a quick one, Adrian. The big debate is also on the dollar, whether this year the dollar index is headed towards 150, 120, or maybe even higher. What's your own view, and do you think that could sort of derail the emerging market rally a bit?
Well, I think it already, is impacting risk assets. I mean, these things are all linked up there. You've got Europe facing extreme pressure in terms of contraction in discretionary income because of the rise in energy prices. You've got Japan continuing to pursue quantitative easing and targeting bond yields. And you combine that with a U.S. economy that's proving much more resilient than Asian and European economies, and a central bank that's articulating they're going to be tight on inflation. So I think the dollar will continue to move higher into the final quarter. But I would be looking ahead to next year and thinking about what are the trades to put in place. And one place I'm looking a lot more at the moment is Europe. If you're a European manufacturer with the euro at parity, that could be very attractive for your year-on-year comparisons, for your ability to win export orders. So I think there are opportunities there. And I would expect that the dollar index peaks in the final quarter of this year, and that actually you'll probably get some quite powerful trades with a recovery in the euro and a recovery in the yen. Now, you could get events, if we were to get some more resolution around the European energy crisis, then that could be very bullish for the euro. Sorry.
No, absolutely. I mean, that is the overarching theme, right? Governments across the globe trying to bring spiraling inflation down. I mean, the recent one we heard was Argentina hiked interest rates by 550 basis points. They have, inflation has been overshooting quite a bit over there. And that's just one case, right, out of so many that we talk about. All right. Thanks, Adrian. We've run out of time, but thanks a lot for joining in and speaking to CNBC-TV18. Well, that's the word coming in. The global situation is not looking good at the moment, but India is standing tall. Let's slip into a quick break. On the other side of the break, our list of top 10 stocks lined up.